Hey, what's going on, everybody? Welcome to another edition of 5 Charts with LPL Research. I'm your host, Scott Brown. Now, before we get into today's slides, we did want to quickly acknowledge that Ryan Dietrich, our Chief Market Strategist, is no longer with LPL. You may have already heard, and certainly we're sad to see him go. Ryan was instrumental and has been instrumental in my career. He was incredibly instrumental in getting this particular video series off the ground and giving me an opportunity to kind of showcase the work that I've been doing for our advisors. And so while we took last week off, and we're still kind of hammering out what exactly we want to make this show going forward, if we're going to have guests, if I'm going to run it solo, the one thing that we're sure of is we want to keep the momentum going. So we want to keep bringing you 5 charts with LPL Research every single Thursday, and we're going to continue to do that. So with that, let's get in to this week's slides. First one, I think, is probably one of the most important stories, maybe not the most unique chart we're going to bring you this week, but it's the euro breaking down to 20-year lows, lowest level since about November, December of 2002. We've been looking, everybody's talking about parity. Parity, we've gotten so close. It's actually 1.03 has been where we've reversed multiple times over the past 7 to 8 years. Well, we're through that. Big breakdown on Wednesday of this week. Major move. And as you can see, again, everyone's going to be talking about parity, the magical €1 equals $1. That's just a penny away. But there's really no support below this. So maybe some kind of policy intervention stops this from going all the way to where it technically, frankly, should. But there's really no support until the 2000 and 2001 lows down there in the mid 80s. So just something to be aware of. But we think this is really key because the dollar had already broken out to 20-year highs. But for our standpoint, we were at least a little bit wary that, that didn't seem sustainable without the euro also breaking down and confirming that move. That's now happened. And so I think dollar strength is probably something that we are showing is very correlated with equities going lower. And it's probably goes firmly into the not so bullish bucket in our view for risk assets overall. Let's look at our next chart. We've got nat gas prices, and I think just a good example of why technical analysis and charts are really helpful. Nat gas prices are down about 45% from their highs just a month ago. And so if anything else in the world was down 45%, you would most certainly say this is a terrible chart. This is clearly a downtrend. You would just look at that and say this is something that's an asset that is clearly going down. But the chart for natural gas really helps put this in perspective, because if we look back to 2020, routine pullback within a clearly defined uptrend channel is really how we see it. And you can see this is weekly candlesticks. We're actually getting a big move up and kind of responding off of the lows of last week here today at roughly that 40-week moving average. So just, kind of be aware, this is still an uptrend. We've seen some cracking commodity prices, soft commodities, industrial metals, precious metals were already really not doing anything. But energy commodities, maybe they're eventually going to fall in there. But for now, we've got to respect the uptrends. And despite the huge magnitude of, percentage declines for nat gas, this is still an uptrend to our eyes. Let's keep it going with that kind of energy dynamic. This is the ratio of the S&P 500 energy sector versus the consumer discretionary sector. Now, both of these sectors performed really well in the first 18 months or so off the March 2020 lows. They were top half of S&P 500 sector returns through about November of 2021. And then oil, if you remember, we had about a 26% correction in oil. Prices broke back up about $85 a barrel, and that's where we really started to see things split. We also started to, of course, see equity market weakness around the turn of the year, but energy, the lone outperformer, the lone sector actually up so far year to date for the S&P 500. Consumer discretionary has consistently been the worst, and you can see that really play out in this explosive move over here. That move basically completed a long-term inverse head and shoulders pattern. We went all the way through this 12-year downtrend channel, blew out the other side of it. Now we've actually seen a big pullback over the past month. We've seen those prices correct in energy commodities, crude oil included. Energy stocks have pulled back about 25% from recent highs. And the discretionary names have, let's let's say it just held in there a little bit. That's mostly all they've really done. They haven't gone so much up, but we just want to highlight this because this is another trend that's still intact. It still looks like we should be favoring energy over discretionary. Now, if we crash through that support line, that was actually the target from that inverse head and shoulders pattern. We obviously went through it. It's the top of that downtrend channel. We think we should be roughly in the range where it probably looks, you might want to be selling some discretionary, adding some energy. But from the macro standpoint, hey, if we break down, that's probably a better thing for the broader market, because certainly we know the big discretionary names have a lot of weight in the S&P 500 and major traditional benchmarks. The energy names are certainly sucking away from consumers' wallets. So it's probably better if this actually breaks down. I just don't think we actually have enough evidence to say that that's the bet we want to make. We'll keep with the macro theme and just want to highlight something that's, really sending a pretty clear message. This is the yield curve. Now, people will debate, which specific tenors you can look at and things like that, and which ones have the most reliable history. But there's no doubt that most people look at 10s minus 2s, the 10-year spread minus the 2-year spread, or the 2-year yield, and the difference between the two. And right now, the 2-year yield is paying you 5 basis points more than the 10-year yield. That is not normal. That is not natural. And that is something that historically happens before recessions. And after kind of getting there briefly a couple months ago, we're back there, and we seem to be spending a lot more time there so far this week. So just something to be aware of. This is not something you want to ignore. It really doesn't matter what part of the yield curve you look at. It's not sending any especially healthy messages. And even if you want to use that 3-month thing, we know that the Fed is going to keep raising. And so if your case is that, the 3-month minus in 10-year hasn't inverted yet, that's probably going to happen in the next 2 months if they raise by the 75 basis points here this month and the 50 basis points in September that the market is forecasting. So just something to be aware of there. The last one, and I guess it all ties together. We're talking about the Federal Reserve. That has been the primary worry, at least as I see it, with the groups affected from the market so far. And we see that in the form of, stocks that really require liquidity and speculation doing the worst over the past year plus. Software is one of those that would be in there. But recently, we've started to see a shift towards actually it's the more cyclical things. The things that do worse in recessions are actually becoming the worst performers. This is the Dow Jones Transportation Average up in the top panel. That breakdown below about 14,000 is really important to us because there's just no support until you get back to around 11,000 or so, that big range from about 2019 and the pre-COVID highs. And so if we're below 14,000, you just got to think transports are going lower. What's interesting, though, is we're actually seeing transports now underperform the software and services name. Really a good proxy. There's a lot of them you can look at. But for those areas of the market that did so well for so long, while transports, they weren't going down, but certainly haven't been any special outperformer over the past decade. It's been all about software and services and tech names and things like that. Software and services gotten killed, but now it's kind of showing a little bit of resiliency. The way I interpret that is the market is suddenly maybe shifting from its eyes looking just at the Federal Reserve and taking away liquidity and things like that to actual recessionary fears. So I think that shift under the surface is something we really need to continue to monitor. So that is the 5 charts that we have for you this week. Again, we will be sure to bring this back next Thursday. We'll have another 5 charts and keep you abreast of all the most important macro movers, great charts to profit from, charts to avoid, whatever we're seeing. We want to continue to bring you that. So thanks for listening. Thanks for subscribing. And we will be back with you next week for LPL Research. This has been Scott Brown.